You see these mutual fund statements. March में जब tax filing का time आता है, तो most investors just accept whatever capital gains tax they owe. But what if I told you that there is a completely legal way to cut down your taxes, a technique that can save you thousands in taxes? But 90% of retail investors don't even know it exists. It is called tax harvesting. It is not some complex CA trick or some shady loophole. It's a legitimate strategy that even the income tax department recognizes. Today, I'm going to show you exactly how it works and why you should care, especially if you are someone who regularly invests in equity mutual funds. Now let me explain you why most investors miss out on tax harvesting. It's not about intelligence. It's about how our brain is wired to think about taxes. When you think about taxes, what comes to your mind? Section 80C investments, ELSS funds, and maybe some NPS contributions. All about putting more money to save tax, right? But here is the interesting part. Our tax system allows you to manage your existing investments to reduce your tax liability. Most people never think this way. There is a psychological barrier. Selling investments feels like booking losses or making mistakes, even when it can save you significant tax money. But smart investors understand that tax harvesting isn't about making mistakes. It's about making the tax system work for you instead of working against you. Here's how it exactly works, and trust me, it's simpler than you think. Tax harvesting has two main strategies, and both are completely legal under the current tax laws. First one is tax loss harvesting. Suppose you have mutual fund units showing paper losses. Instead of just holding them and hoping that they'll recover, you sell these units before 31st of March. These losses can be set off against the capital gains that you have made from other investments. For example, you made 50,000 capital gains from one fund, but another fund shows rupees 20,000 loss. Sell the loss-making units, claim the 20,000 loss against your gains. Now you pay tax only on 30,000 instead of rupees 50,000. Second is tax gain harvesting, which is an even more interesting strategy. If you have long-term capital gains up to rupees 1 lakh, they are completely tax-free under section 112A. But most people don't utilize this limit fully. Now let's come to the solution. Sell the profitable units to realize the gains up to the exemption limit. Then reinvest the money back into the same fund or similar funds. Now you've essentially reset your cost price to the current market value without paying any tax. Future gains will be calculated from this new higher base. Now let's come to the reinvestment twist. In both the cases, you can reinvest your money into the same fund or similar funds. Market exposure continues, but your tax position improves significantly. Some investors use this opportunity to rebalance their portfolio while optimizing taxes. Common pitfalls to avoid. Don't harvest losses just for the sake of it. If you genuinely believe in the fund's long-term prospects, market timing risks remain. Don't ignore exit loads and transaction cost. Sometimes the cost outweigh the tax benefits for smaller amounts. Don't create unnecessary complexity in your portfolio just for marginal tax savings. Tax harvesting requires some planning and monitoring, but the benefits can be significant over time. Step 1 is to review your portfolio. Before March, review your entire mutual fund portfolio. Identify funds with unrealized gains and losses. Step 2 is to calculate the impact. Work out the tax implications of different harvesting scenarios and consider both current year benefits and future impact. Step 3 is to execute strategically. Time your transactions to optimize tax impact while maintaining the investment discipline. Step 4 is to reinvest wisely. Use the opportunity to rebalance if needed, but don't drift away from your core investment strategy. Step 5 is to maintain the records. Proper documentation is crucial for filing returns and future tax planning. Now the bottom line is that tax harvesting isn't about getting rich quickly or beating the system. It's about being smarter with money that you've already invested. Most mutual fund investors end up paying more tax than necessary because they don't know these strategies exist. The tax code gives you these tools. Use them wisely. Remember, आपके पैसे, आपके tax benefits. Don't let ignorance cost you money that you could legally keep in your pocket. Have you ever tried tax harvesting before? If not, this March might be the perfect time to start.